Hello, friends. Today we're taking a look at Dollar Tree, ticker symbol DLTR. This company will be announcing, reporting their earnings this week, and I just wanted to take a look at because if you look over here in the last month, they are up 10%, but year to date they're down almost 22%, and they have been close to their 52-week low of 177. $102.77. The analysts are thinking that it will go up close to around 145, where it was most of the year. In the last 5 years, as you can see, it's up 40%. And so if it were to go back to the 145, that would be an upside of 24%. They don't pay a dividend as of right now. So for those of you that don't know who Dollar Tree it's a company that actually owns two sections, the Dollar Tree stores, but also the Family Dollar stores. And these are stores that sell cheap food and items. It used to be for $1, but not everything in there is going to be $1. So a lot of people are looking at these companies, the same thing with Dollar General, because as they are expecting a possible recession next year, then these companies might see an influx of customers as they are downgrading from other type of places to buy their food, grocery stores and stuff like that. Let's take a look at last quarter's earnings. They beat by a little bit, 0.4 and 4 cents and 5 cents, and they beat in revenue by $120 million. Upcoming, they're looking at a 10-cent growth. There has been in the last 90 days. However, there has been a 1 revision up and 8 revisions down. So we'll see what is going to be happening. But the question is Dollar Tree a buy? Well, before we answer those questions, let me just remind you that I am just a YouTuber. I'm just sharing my thoughts over here. I'm not a financial advisor. You should not be making purchases or selling this company based on my opinion. I would love to hear your opinion. So if you want to subscribe to our channel, I will really appreciate it. But most importantly, if you write comments and let me know where I get wrong here or what I get right and things that you appreciate about this. If there's any other company that you would like me to look at, just write it down there. When it comes to revenue, we can see that the revenue has been going up. Dollar Tree is been growing at a pace of about 13% a year, in about 6.7% in the last 5 years. When it comes to earnings, they are up. No, they have remained a little flat, and this is part of the reason I believe why this company has been having some issues lately. It's just because it has been flat, as you can see, 2020, 2021, and then the trailing 12 months stays somewhere around the $550. So before that, it was in the 350. So it seems like if you look at this progress, it does tell you that in the last 10 years, they have been growing at about 7% a year. I will not be paying too much attention to the last 5-year number here because, of course, there was a big loss on 2018. To be honest with you, I did a deep dive on this company. It's a company that I'm just kind of taking a look see if I will invest, if I will go and do a bigger dive on it. If you're thinking about buying this company, I will highly encourage you to go back to the 2018 10K and then look and see why this loss, a really significant loss in 2018. Profit margins are about 5%, which means that for every $100 of revenue they receive, they get about a $5.04 of earnings. Free cash flow is being a little steady. There was a big jump on 2020, but other than that, actually, if you look from 2016, it has been going down. This is another concerning thing, that if I was looking at buying this company, I would be worried about this. Also, one of the things that it could be happening is that these companies, it would be good for you if you want to buy this company to start looking at where they purchase most of their products. Are they coming from China? Is that raising the cost because of oil and because of all of the different issues between the United States and China? Or are they locally, and is that affecting their margins? Well, I can see here that the free cash flow margin in the last 5 years is 3.5%, which is pretty low. And in the last 10 years, they have free cash flows have kind of remained flat. Book value per share has been growing steady in the last 10 years, about 22%. This will be a reason why to look at this company. And in the last 5 years at 11%. Return of equity is 18% average in the last 5 years. Return of assets at 6.3%, and return on invested capital is a little lower than 10% at 8%. I normally like it to be at least 10%. Better will be is 15. Just a little note here. I just published PayPal, and I'm looking at the numbers, and this is part of the reason why PayPal also have kind of issues, because whenever you're comparing it, their return of equity, PayPal is supposed to be an amazing growth company, and they're not doing that. So anyway, that's just a little note there. When it comes to dividend, they don't pay any dividend. When it comes to debt, they have a lot of debt from my perspective. Debt has been growing about 27% in the past 10 years, which it might not tell you too much, but in the last 5 years, it's about 17%. So, and if you remember, there was something happened here in 2018 with the earnings, and now looking at the debt, you can see that the year after the 2018 loss, their debt went really high on 2019. I wonder if it has something to do with maybe acquiring Family Dollar. It's just a thought there. Maybe I'm wrong when it comes to that. But what I find very alarming is, and a reason right now I will tell you I will not invest on this company, will be because they have a high debt, and that worries me, especially as we're going into a possible recession year. Their free cash flow average is about 5. In the last 5 years, it will take them 11 and a half years to pay all their long-term debt. And of course, that is if they maintain these levels of free cash flow. So whenever we look at the historical multiple valuation, if you want a little more explanation about these numbers, you should go and look at my PayPal video, in which I explain a little bit more. I'm working on a video that it will explain a lot of these valuations and how I come to it. But if we were to look at the trailing 12 months, that will be somewhere around a fair price of $120 And if we take the average in the past 5 years numbers, then that will be about $102. So it will be between 102 and 120 what is being fair based on what the market has been paying in the past 10 years. When it comes to payback valuation, if we were to take the average in the past, I think I will probably be looking more at it's closer to the trailing 12 months. But if you wanted to look at the average, since it remained flat at 1%, and if you were to collect for the next 15 years, their free cash flow, that will be about $60 on the average free cash flow of $3.51. When it comes to discounted earning valuation, if we were to take the trailing 12 months and grow it at 5%, we will have a future value of $140. And then whenever we assume a 20 PE, 140, if we discount it back, that will be around $70. If it's average, if we were to look at the average numbers, that would be about close to $45. If we use Buffett's owner's earnings valuation, we're looking at somewhere between $24 to $44, which I'm not sure if this will be the best valuation for this kind of company. So if we put all the numbers together, we are looking at somewhere around 86, from $80 to $86. Right now it is trading at 118 with no discount. So if we were to, for example, let's say that we said, hey, I don't think that the cap numbers apply to this kind of business, we're still looking at somewhere between $85 and $97. I will personally stay away from this company if you were wanting to buy this company and you wanted to put a 20% margin of safety. That will be an average entry point of about $75, which will lead you to almost pandemic time of that kind of valuations. Well, that is what I have for you guys today. Thank you for listening and have a nice one.